KVB PRIME, developed for global traders, growing together with you.
Hello, welcome to KVB Prime Weekly Analysis. This week's topic is what changes has COVID-19 brought to us. We will start by looking at the US. The number of confirmed cases in US has skyrocketed to over 360,000, with death tolls over 10,000 people. In order to combat the economic shock of the pandemic, the Fed had introduced various policies to stimulate the economy. First, on the last trading day of February 2020, US stock experienced Black Friday. US responded by, on 3rd of March, Fed announced an emergency rate cut of 0.5%. This act, however, did not calm the stock market. In fact, it was seen as a fee signal. Hence, US stock fell 2.81% as a result. What followed was the market triggering circuit breaker twice on the 9th and the 12th of March, creating world history. On 15th of March, Fed once again announced an emergency rate cut of 1%, cutting the cash rate to 0 to 0.25%. On the same day, US government announced a quantitative easing plan of $700 billion. However, this did not calm the market. It once again added to market fear. On 16th and 18th of March, the market again triggered a circuit breaker another 2 times. In between the 2 weeks, US stock market continued to refresh world records, including stimulus package larger than one introduced during the GFC 2008. On the 23rd of March, Fed announced unlimited QE plan and open asset purchasing plan. For the first time in history, the government provided loans to firms to purchase bonds. The release of this policy led to large market fluctuations before the market began to rebound. On the 27th of March, US Fed introduced the largest stimulus package in history, total worth of $2 trillion. The package included unlimited unemployment benefits, loan support for businesses, and purchase of medical supplies. The entire March overall had experienced large economic shock from COVID-19 and an increased market fear. Although the US government had introduced strong stimulus package to combat the shock, however, it is difficult to determine the effectiveness until we examine closer the economic impacts after COVID-19 and the possible consequences of these policies. Next, let's turn our attention to Europe. Statistics showing that the number of confirmed cases in the Eurozone had exceeded 400,000. Amongst the strongest hit country was Italy, Spain, Germany, and France. In response to the economic shock, members of Eurozone had introduced the following. First, currency stimulation. 12th of March, European Central Bank had extended the asset purchasing limit from 20 billion a month to 120 billion. On the 19th of March, Central Bank extended QE plan by 750 billion euro, totaling the yearly QE plan to 1.1 trillion. 26th of March, European Central Bank dismissed the underlying limits of its members in purchasing government bonds. And the second policy that they have introduced is in supporting liquidity and financing. On 12th of March, European Central Bank decreased the targeted longer-term refinancing operation rate by 25 basis points, currently sitting at 0.75%, and provided cheaper loans to commercial banks. Now let's look at Australia. Australian government responded to COVID-19 by cutting the interest rate twice over the past month and introduced a stimulus package worth 214 billion Australian dollars. On the 3rd of March, Reserve Bank of Australia decreased the cash rate to 0.5%. Australian dollar climbed to 50 basis points after the release, while ASX 200 plunged. On 13th of March, the Morrison government announced a stimulus package worth 17.6 billion. At the same time, the stock market fell into bear market, falling 3.5%. Comparing the stock market on the 20th of February, ASX 200 had fallen over 20%. On 19th of March, RBA once again announced an emergency rate cut of another 25 basis points, currently at 0.25%. Simultaneously, the government had announced a QE plans of purchasing government bonds. After the release, ASX 200 surged 3.02%, while Australian dollar also appreciated 90 basis points against the US dollar. On the 22nd of March, Australia declared a lockdown and Prime Minister Scott Morrison announced the second round of stimulus package worth 66.4 billion Australian dollars. However, this time, the stock market plunged over 8%. On 30th March, Australian government announced the third round of stimulus package worth $130 billion, ensuring the employment of Australians. As a direct result, ASX 200 surged 6.6%. Now let's look at weekly highlights. This week's weekly highlights are US dollar climbed 2.33%, Euro fell 2.94%, British pound fell 1.45%, Australian dollar fell 2.83%, WTI climbed 32.43%, Dow and S&P 500 fell 2.3% and 1.67% respectively. Next, let's look at weekly asset analysis. First up, we have the US dollar. US dollar, after the poor adjusting phase last week, experienced a well-performed rebound. Although it did not rebound back to the recent high price point 103.0, however, after stabilizing on 98.2, the market peaked over 100. The overall performance was satisfying. As long as the market doesn't fall below the technical support 98.2, the overall uptrend of the dollar will not change. The trading strategy for this week will be monitoring the long market response. Next, we have Euro. On the other hand, the loss of Euro totaled to 2.94% for the week. The market had an obvious downfall channel, easing the prediction of intraday analysis. The predicted upper resistance 1.1500 and the lower support 1.0630 continue to perform strong, especially the resistance 1.1500 in preventing the market advancement. Currently, the fluctuation level is getting smaller, which may bring opportunities for traders. Thus, traders should monitor the strength of 1.1150 and 1.0630 in preventing market advancements. Next up, we have British pound. The market trend for British pound could be summarized as shrinking fluctuations. As predicted last week, pound wanted to leave 1.3200. Currently speaking, it has low potentials, and we should monitor the upper pressure of the pound that pound will experience and the potential for market change. Unsurprisingly, the technical rebound began to adjust below 1.2490 before hitting the key resistance 1.2750. This week, traders must take care of two opportunities. Number one is the current resistance 1.2590, and the second one is when the market break open the lower support 1.2120. To ease the catch of the market trend, traders can examine the daily market trend following the ideology of strong resistance preventing market movements. Once pound fall below 1.2120, pound will have the potential for a further fall. Last up, we have gold. The gold market reduced its movement last week, decreasing fluctuation strengths. The low support 1,553 and the upper resistance 1,635 may not be strong enough to prevent the ambitious gold prices from moving up. Technically speaking, monitoring the market response between the upper resistance 1,635 and the lower support 1,553. Overall, 1,553 is a key support position. This ensures gold will have enough potential for a possible challenge of the upper price 1,702. Otherwise, as long as the market doesn't fall below 1,450, the overall fluctuating uptrend will not change. 1,450 is the technical foundation for this uptrend. That's all for this week's KVB Prime Weekly Analysis, and thank you for listening.